Most people approach debt elimination the same way they approach most financial decisions, intuitively. Pay the smallest balance first, because closing an account feels like progress. Pay the highest balance first, because the biggest number feels most urgent. Pay whatever has the most emotional weight, because the emotional weight is real and it influences behavior. None of these approaches are irrational, but none of them are optimal. And the gap between the intuitive approach and the optimal one is a measurable dollar amount, real money paid in interest that didn't need to be paid. The order of debt elimination matters because of how interest compounds. Every dollar of principal on a high-interest balance is generating interest. Every month that balance exists, at whatever rate it carries, that interest is being extracted from the position. Eliminating a balance doesn't just remove the principal, it removes all future interest that principal would have generated, which means the order of elimination determines the total interest paid over the entire debt elimination period. Pay the highest rate balance first, and the most damaging compounding is stopped earliest. Pay any other balance first, and the highest rate compounding continues longer than it needed to. The difference in total interest paid between the optimal order and any other order is real, measurable, and often significant. This is the mathematical case for what's commonly called the avalanche method. Pay minimums on all balances. Apply every available dollar above the minimums to the highest interest balance. When that balance is eliminated, redirect its payment to the next highest rate. Continue until all debt is retired. The avalanche method minimizes total interest paid. It's the mathematically optimal approach to debt elimination, assuming the goal is to pay as little as possible over the entire elimination period. That assumption is usually correct, but not always. And the cases where it isn't are worth understanding. The competing approach is the snowball method. Pay minimums on all balances. Apply available dollars to the smallest balance first, regardless of rate. Eliminate it. Redirect its payment to the next smallest. Continue until all debt is retired. The snowball method doesn't minimize interest paid. It minimizes the number of open accounts, producing the psychological wins of closing accounts faster than the avalanche produces. And psychological wins matter, not as a financial variable, but as a behavioral one. A debt elimination strategy that gets abandoned because it produces no visible progress for months is structurally inferior to a strategy that costs slightly more in interest but gets executed consistently. The optimal strategy is the one that gets completed, not the one that saves the most on paper if it gets abandoned halfway through. Which means the right approach depends on an honest assessment of the individual's behavioral capacity, not just the mathematics. Someone who needs visible wins to maintain momentum may be better served by the snowball, even knowing it costs more. Someone who can sustain motivation through a long period of slow, visible progress benefits more from the avalanche. The financial difference between the two is real, but so is the behavioral difference, and the strategy that accounts for both is the one most likely to produce the outcome both are aiming for: a position with no high-interest debt. The avalanche and the snowball are the two primary frameworks for structured debt elimination. They're often presented as competing philosophies, the mathematical approach versus the behavioral one. That framing understates the nuance. Both have structural logic. Both produce results. The question is, which produces more given the specific combination of debt and the specific behavioral tendencies of the person eliminating it? The avalanche wins on total cost. By directing maximum payment toward the highest rate, it stops the most damaging compounding first. Every month, the highest rate balance exists. It generates more interest per dollar of principal than any other balance. Eliminating it first means that rate stops compounding before any other rate does, which reduces total interest paid across all balances by more than any other sequencing would. The math is unambiguous. Given equal payments and equal time, the avalanche produces a lower total cost than the snowball in virtually every scenario. The snowball wins on behavioral compliance. Closing accounts produces a specific psychological effect. The account is gone. The minimum payment that was going to it is now available for the next target. The progress is visible. The momentum is real. For people who struggle to maintain motivation through the early phase of debt elimination, when the avalanche is producing minimal visible progress because the highest rate balance is also often the largest, the snowball provides evidence that the strategy is working, earlier than the avalanche would, more visibly, more emotionally satisfying. And behavioral compliance, continuing the strategy, is the variable that determines whether either method produces results. The honest comparison looks like this. The avalanche saves more money, sometimes significantly more, depending on the rates involved and the timeline of elimination. The snowball produces faster visible wins, which may or may not matter, depending on how much visible progress affects the consistency of execution. For someone with strong behavioral consistency, who doesn't need the early wins to stay on track, the avalanche is clearly superior. For someone whose consistency is genuinely dependent on momentum, the snowball's cost premium may be worth paying to ensure the strategy gets completed. The premium isn't always large. It depends on the specific balances and rates, but it's real, and it should be evaluated honestly, not rationalized as preference when it's actually a behavioral accommodation. There are also hybrid approaches. Pay off the one or two smallest balances first to simplify the debt picture and generate early wins. Then switch to the avalanche for the remaining higher rate balances. This approach gets the behavioral benefit of the snowball in the early stage, when motivation is most fragile, while capturing most of the mathematical benefit of the avalanche for the larger, higher rate balances. It's not theoretically optimal, but it's often practically optimal because it accounts for both the mathematics of interest and the reality of human behavior over a multi-year elimination period. Subscribe if you want to keep thinking about this differently. We're just getting started. The conventional framing of debt elimination presents it as a prerequisite. Pay off the debt first, then start building, then invest, then work on the financial position. This sequencing is intuitive. It feels responsible. Get clean first, then move forward. And for high-interest consumer debt, it's often structurally correct. The return available from eliminating 20% interest debt is a guaranteed 20%, which is difficult to beat with any investment in a comparable risk profile. But applied universally, to all debt regardless of rate, this sequencing is often wrong, and following it costs real money over time. The question is always about the rate, not whether to pay off debt or invest, but at what rate does paying off debt produce a higher guaranteed return than investing the same capital? Debt at 20% interest, paying it off generates a guaranteed 20% return. Very few investments produce that reliably. The math favors elimination. Debt at 3% interest, paying it off generates a guaranteed 3% return. A diversified long-term investment portfolio has historically generated significantly more than that. The math favors investing. The crossover point, the rate at which paying off debt is mathematically equivalent to investing, is somewhere in the middle, and the specific number depends on the investor's expected return and their personal risk tolerance. In practice, this means high-interest consumer debt should be eliminated aggressively. Credit cards, personal loans at high rates, any debt where the interest rate exceeds what the investor could reasonably expect from a comparable investment. And lower-rate debt, a fixed-rate mortgage, a low-rate student loan, a business loan at below-market rates, should be serviced at minimum while available capital is invested. Not because the debt doesn't matter, but because the opportunity cost of paying off low-rate debt ahead of schedule rather than investing the difference is real and compounding in the wrong direction. This requires separating the emotional from the structural. Debt feels bad. All debt, regardless of rate. The feeling of being debt-free is genuinely valuable, psychologically, if not always mathematically. But financial decisions made primarily to relieve an emotional discomfort rather than to optimize the financial position often produce structurally inferior outcomes. The person who paid off their 3% mortgage early to feel debt-free while the market returned 7 or 8% made a decision that felt right and cost real money. The feeling was real. So was the cost. The framework that produces better decisions is rate-based, not emotion-based. Eliminate high-rate debt aggressively. Service low-rate debt while investing the difference. Never treat all debt as equivalent regardless of what it costs. The emotional instinct to be debt-free is understandable, but financial freedom isn't built by eliminating all debt as fast as possible. It's built by understanding what each debt is costing and making the decision that produces the best financial position over the relevant time horizon. A debt elimination plan that works isn't the one with the best mathematics. It's the one that gets executed. Completely. Consistently, over however long it takes. And execution over time requires more than a strategy. It requires a structure, one that makes the right behavior the path of least resistance rather than a continuous act of discipline. The first element of a working plan is a complete inventory. Every balance, every rate, every minimum payment, every term. Not an approximate picture, a precise one, because the sequencing decision, which balance to target first, can only be made correctly with complete information. And the psychological relationship with the total debt picture changes when it's mapped precisely. The amorphous weight of owing money without a clear view of the specifics often feels larger than it is. The precise inventory converts an emotional burden into a specific problem with a specific structure and a calculable timeline to resolution. The second element is a target sequencing decision, not a permanent commitment, a deliberate starting point, based on an honest assessment of two variables: the mathematics, which sequence minimizes interest paid, the behavioral reality, which sequence is most likely to be sustained. For most people, a modified avalanche that begins with 1 or 2 small wins, then shifts to rate priority, balances both variables reasonably well. The specific choice matters less than the consistency with which it's executed. The third element is automation. The debt elimination payment, above the minimum, should be automated. Not decided each month, not subject to whether the money feels available. Set up as a fixed, automatic transfer on payday, before discretionary spending, before any other allocation, taken off the table. Automation removes the behavioral decision from the most critical moment, the moment when the money is available and competing uses for it are also visible. The automatic transfer doesn't feel the temptation. It just executes the plan. The fourth element is protecting the plan from the events that derail it. An unexpected expense, a period of reduced income, a month where the payment feels impossible. These events don't just interrupt the plan temporarily, they can end it if there's no structure for how to respond to them. A small emergency fund, separate from the debt elimination capital, absorbs the unexpected expenses without requiring the debt elimination payment to be skipped. A predetermined response to a period of income reduction, which minimums stay paid, which additional payments pause temporarily, keeps the plan from collapsing entirely when conditions temporarily change. The plan that accounts for disruption survives it. The plan that assumes smooth sailing often doesn't. If this gave you a clearer picture, subscribe. Like this if something clicked.